In this video, we are continuing to look at the income statement and ratio analysis and measures of profitability. In this video, we are focusing on the profit margin, and the profit margin is calculated by dividing profit by net sales. Net sales if we're a trading entity. It's always expressed as a percentage. The profit margin is defined as the profit generated from each dollar of sales, and it indicates the effectiveness of management to minimize operating expenses per dollar of sales. A business will always attempt to increase its profit margin. More profit, the better. As we want a higher profit margin, a low ratio is problematic, and it indicates that there would be less opportunity for profits to be distributed to owners and shareholders. Owners and shareholders always would prefer higher margins, higher profits, and so a low ratio indicates less opportunity for those profits to be distributed. It indicates the need to investigate expense control methods. A profit is derived from revenue less expenses. Either when looking at expenses, if profit is too low, one half of the equation is expenses, and expenses could be too high. A wise man once said you can always cut 5% from expenses, no matter where your expenses are at. And so you would need to investigate your expenses and methods of control. Pricing practices and selling techniques. So the other side of the profit equation is revenue. We need to look at increasing revenue. And so this is one of the areas to improve. The business needs to look at increase in revenue. This is a direct result from pricing practices and selling techniques. So through increased prices or advertising, you need to do some market research. It's not sufficient to simply increase prices because you may be in a competitive market and you may not be able to increase prices and maintain the volume of sales. You may need to increase the volume of sales at the same price, and of course advertising and marketing will come into play there. Decrease costs in any way possible. For example, reducing staff, which is one of the biggest expenses in businesses nowadays, particularly in the Western world, and reducing your COGS. If you're a trading business, purchases in less all your cost of goods sold. If we can reduce those costs, that will increase our gross profit and our bottom line profit. Let's have a look at an example. Let's calculate the profit margin for these two businesses. Eden Enterprises has net sales of $80,000, cost of goods sold of $45,000, and other operating expenses of $30,000. Our profit margin is calculated by dividing profit by net sales. Net profit is $80,000 minus COGS of $45,000 minus other operating expenses of $30,000. Divide that by 80. That, by the way, 45, that's 30. That's going to be 5,000 divided by 80,000 equals 6.25%. It sounds quite low. Let's keep looking. Monaro Markets has sales of 100,000, sales returns of 5, COGS of 60, and other operating expenses of 20,000. The profit margin, not the gross profit margin, is profit divided by net sales, which is 100 for sales minus 5,000 of sales returns, minus 60,000 of COGS, and minus 20,000 of other operating expenses. That would give you $15,000 divided by 95,000 of net sales. That gives you a profit margin of 15.8%. That sounds a lot better than Eden Enterprises of 6.25%. Let's look more. What observations can be made if the industry standard is 10%? Eden Enterprises has profit margin of 6.25%. This is considered unfavourable as it is below the industry standard. We would say that remedial measures appear necessary. Further, we could say or observe that Eden Enterprises are less efficient at generating profit from their net sales. Monaro Markets, on the other hand, the profit margin is 15.8%. This is considered favourable as it is above the industry standard. We would say that remedial measures appear unnecessary. And further, we could say or observe that Monaro markets are more efficient at generating profit from their net sales. When commenting on profitability of the business, what we want to do is define the terminology used, describe the ratio, comment on the results and any trends. Trends must be over 3 accounting periods. We want to analyse the impact on the business and, if needed, recommend strategies to improve the ratio. So now let's make comment on the profitability of Eden Enterprises. First, we'll define the ratio, which is the profit margin. This shows the amount of profit generated from each dollar of sales. It indicates the effectiveness of management to minimise operating expenses per dollar of sales. The industry average profit margin is 10%. Eden Enterprises' profit margin is only 6.25%, which is unfavourable as it is below the industry standard. Eden Enterprises makes only 6.25 cents worth of profit from every dollar of sales. That's how we can interpret the 6.25% profit margin. What can we do about this to improve the profit margin? Eden Enterprises could seek to reduce the COGS and/or the operating expenses, or increase the total sales. They are the 3 areas that affect the profit: the revenues less expenses, expenses and costs being COGS and operating expenses. Anything that can reduce the expenses and costs, and anything that can increase revenues can improve the profit margin. Let's now comment on the profitability of Monaro markets. First, we'll state the ratio we're using. We are using the profit margin, which shows the amount of profit generated from each dollar of sales. It indicates the effectiveness of management to minimise operating expenses per dollar of sales. The industry average profit margin is 10%. Monaro markets' profit margin is 15.8%, which is favourable because it is above the industry standard. Monaro markets makes 15.8 cents worth of profit from every dollar of sales. This here is the interpretation of what the profit margin of 15.8% means. 15.8 cents worth of profit from every dollar of sales. With the profit margin, reasons for increases in profit margin include rising revenue, increase in gross profit, falling expenses, and a larger scale of operations spreads fixed costs over more sales. What is that saying? More operations, large operations, greater volume of sales spreads the fixed costs over each individual item. Reasons for decreasing profit margin include falling revenue, a decrease in the gross profit margin, and rising expenses. Stakeholders who might use the profit margin when assessing the income statement. Owners and managers would use the profit margin when they make calculations for determining efficiency and profitability, when they are monitoring performance by comparison against past performance, competitors, key performance indicators, and industry benchmarks. The economic decisions that these users would be making range from a selection of appropriate strategies to improve profitability by increasing income and reducing expenses, and strategic decisions about business growth or diversification. Other interested stakeholders are shareholders and potential investors. They would use the profit margin and dividend payments to calculate and compare return on investment against other companies and investment options. So shareholders and potential investors want to know how to compare the profit that they would receive from their dollar invested in this business compared to other businesses. And this profit margin is an ideal ratio for shareholders and potential investors when they are assessing buy, sell and holding decisions and evaluating whether the board of directors are performing the role with good corporate governance. Other stakeholders, lenders and creditors, of course, want to know the bottom line profit of any business to know if they can afford the loan. So they are assessing risks when they are providing credit to make sure that a business can afford to repay their existing loans and the loan that they are applying for. Employees might be interested in the profit margin when they want to check profit of individual departments and the overall profitability of the business. They might be doing this as a key performance indicator to benchmark their own productivity and their own outcomes. They may also be looking at their long-term viability of their employment within a business.